Now that we have a general understanding of the 4 fundamental financial statements, we're going to dive a little deeper into each one. We're going to start with the balance sheet. The balance sheet is made up of assets, liabilities, and equity. And as we'll see on a future slide, the fundamental equation for the balance sheet is A equals L plus E. This gives me shivers just looking at it. It's just so wonderful. And the reason it's so wonderful is it's going to be the fundamental concept that we're going to use throughout the entire semester. And better than that, it actually makes logical sense. The only way you and I get money or assets is through either borrowing it, which would be our liabilities, or getting it from friends, family, etc., which would be equity, or earning it ourselves, which is also part of equity. Equity is made up of retained earnings and common stock. I tend to use abbreviations a lot, so it'd be a good idea to take notes and make sure you know what my abbreviations stand for. So R/E is retained earnings. Retained earnings is what it sounds like. It's the profits that were generated by the business and then kept by the business. In other words, not given back to owners in the form of dividends. Common stock is the amount we receive from investors when they purchase ownership in the company. So the only way a company can get their assets is either by borrowing the money, which is liabilities, earning it themselves, which is retained earnings, or getting it from investors, which would be common stock. So that's why the balance sheet always has to balance. You can't get any assets without liabilities and equity. Now, what you see on the slide is a list of various types of asset, liability, and equity accounts. Students always get very intimidated when we start learning about all these different accounts and they want to memorize them all, but you really don't need to. You just kind of need to use a little common sense and think it through logically. Assets are things that provide a future benefit. So I would imagine that most of the items listed under assets are familiar to you, and you can agree that they do provide some future benefit. Like cash provides the future benefit of buying things in the future. Same with investments. We can sell the investments and then buy things with that money. Accounts receivable are amounts that we'll receive in the future from our customers. Well, again, receiving things is a good thing. It provides a future benefit. So we sell to customers on account. They pay us later on. That future benefit is what a receivable is. Note receivable is a little more formal. It involves lending somebody money, and then in the future they have to pay us back. So again, it's a future benefit because they're going to pay us that money back in the future. Inventory is the stuff you see on the shelves at businesses. That provides a future benefit because it can be sold and converted to cash. Supplies are things that we can use in our business to generate income. It'd be things like at UNH, the markers that are used to write on the whiteboard, or the computer that I'm using. Well, not the computer, but the pen that I'm using to write on the screen on the computer. The computer itself would be considered equipment. Still something with a future benefit. Prepaid expenses are what they sound like. They're expenses that you pay for in advance of using them. So a lot of times you pay for your car insurance or your rent before you actually use it. So the future benefit is you get to stay in the apartment, or you get to drive your car and be insured in the future. Long-term investments are just investments that are going to last for more than a year. Buildings, land, I'm sure you know what those are. Intangibles are things like copyrights, patents, and trademarks. It's what prevents us from recording things on Disney Plus and then just posting it on YouTube for everyone to see. YouTube takes it down because it violates copyright law if we do that. You don't need to memorize a list of assets. All of the exams for this class are multiple choice, so you'll have options to choose from. The homework has drop-down menus, which will give you options. You just have to use a little common sense and try to ask yourself, do the items that I see in this list or any other list that you see throughout the semester belong in the list I'm seeing it in? Like, in other words, do you understand why the items under the asset category do provide a future benefit? Liabilities are the opposite of assets. We have to give up something for those in the future. So a common word that you're going to see with respect to liabilities is the word payable, because a liability is something you have to pay in the future, thus payable. Account payable is the opposite of an account receivable. It's an amount that we owe in the future, whereas a receivable is the amount we're going to receive or get in the future. So accounts payable happen when we buy stuff and pay for it later. Accrued expenses is just an accounting term meaning there are costs that we've incurred and haven't paid yet. So usually that happens with utilities. You use the electric and then you pay for it after when you get the bill. Or you may use data on your phone and pay for it after when you get your bill. A note payable would be a loan. So it's a formal account payable. Usually it's going to involve the payment of interest, but we owe it. We're the borrower with a note payable. We owe the creditor. Taxes payable, just like any other payable, an amount we owe in the future, in this case for taxes. Bond payable is a type of loan that we'll talk about later in the semester. The key word, though, with all of those is payable. So that tells us it's a liability. Unearned revenue may seem a little weird. It may not seem like it belongs under liabilities. In fact, a lot of you are going to want to put it under revenue, but that would be a big mistake because unearned revenue is a liability. We haven't earned it yet. This would happen when an airline sells you a ticket. They get your money, but they don't earn it until they fly you. So they have a liability. They owe you a flight, and that liability is called an unearned revenue. Likewise, for UNH, you most likely paid your tuition for this class already, and we're only on Chapter 1. So you prepaid your tuition. You have a prepaid expense, an asset. Your future benefit is listening to this class. Whereas UNH owes you something. They owe you an education. They have your money, but they have a liability, an unearned tuition revenue, because they owe you something in the future. And then, as I mentioned before, equity is made up of two components: common stock, which is the amount we receive from owners, and then retained earnings, which is the amount the business generates in profit and keeps. The balance sheet, remember, is the only statement that's a snapshot at a specific point in time. Here's an example of a balance sheet for Lee Natures Incorporated. And you can see that assets, 527.4, do in fact equal the liabilities and equity of the business. A balance sheet always has to balance, thus the name balance sheet. We're in accounting, I got to admit, not always that creative. So a lot of times the words tell you what it is. A balance sheet is a sheet that balances out. And you can look through on your own the explanation of the various types of accounts. I've already given you an overview of the most common types of accounts that you'll see throughout the semester, and more importantly, in the real world. As I mentioned before, the balance sheet is the fundamental accounting equation. It's really the most important equation we're going to learn for the entire semester. Assets equal liabilities plus equity. We cannot get economic resources without liabilities and equity. So this is always going to balance each and every time. The balance sheet is going to tell us the balance in the asset, liability, and equity accounts at a specific point in time. And the balance sheet always has to balance. The beauty of accounting, you'll learn as we move through it, is there's a lot of ways we can check our own work. There's lots of checks and balances that allow us to determine if what we're doing is actually correct. And this is the biggest check and balance that we're going to use throughout the entire semester. When we start talking about how to record transactions, we're going to do so under this framework of the accounting equation, and we'll be able to determine if we're correct by looking at whether the assets equal the liabilities plus equity once we record the transaction.